Welcome back to Mortgage Markets and More. Happy Friday, everybody. Welcome to October, our first episode in the new month. Flipping the calendar. I hope you're all starting to enjoy the spring-like weather we're having here in the Northeast. I have your update today for mortgage rates, what's going on in the market, and actually, we're going to be talking about something a little different than real estate today for the first time. This will be the first episode where we introduce a little bit of the more from Mortgage Markets and More. So we'll start off where we normally do with the bond market. Bond market has gone up just a little bit as we compare it to last week. So the 10-year Treasury yield is at 3.8%. That's up just a little bit from 3.79 last week. 5-year is at 3.57%, up just a bit from 3.52. And the 2 years, 3.65%, which is up a little bit from 3.53 last week. So overall, that's showing us that interest rates are still a little bit volatile because it's going up. You can see the interest rates going up a little bit, burying the lead. Here we go. Here's where we have our mortgage rates according to Mortgage News Daily survey. We're going to start off with the 30-year fixed rate, which is up to 6.25% on average, which is up a bit from 6.19 last week. The 15-year is at 5.62%, and that's up slightly from 5.55. The 30-year jumbo is at 6.43%, and that's up a bit from 6.43 last week. The 30-year FHA, though, is flat, 5.76%. Average is remaining consistent there. And the 7.6 SOFR adjustable rate mortgage is at 6.15%, up or actually down a little bit from 6.17 last week. We're still now in an interest rate environment that's the highest that it's been in the past 3 weeks, with the FHA kind of staying flat. And I'm asking the question to you, why? Why do you think interest rates have gone up a little bit? Why is the bond market moving the way that it is? I have the answer for you. And there's going to be some more that happens. Again, as of recording this on the Thursday morning before the release of this episode, I just have the data that's available to me right now. And this week we did get some economic data that did move the market quite a bit. First and foremost, we'll talk about the Producer Manufacturing Index. This is giving you a look at how it's going for manufacturing, in general, that sector of the economy. That's in what we call contractionary territory. So essentially, you get a number, and if it's above 50, it's an expansionary. That means business is booming. And if it's below 50, it's classified as contractionary, which means that there's a slowdown occurring. We are in contractionary territory, which is, I think, around 46.7 is where we were at. And it actually is a little bit lower than what the estimate was when that information was released. There was 2 reports released this week. So that moved the market. The other thing was that job openings were about 300,000 more than what was expected. So when we saw the data from Bureau of Labor and Statistics, there was 8 million jobs available, as opposed to 7.7 million, which is what the expectation was. Then we have ADP. If you have a payroll provider where you work and you get your pay stubs and W-2s, you see ADP. Well, ADP provides information about jobs added and whatnot because they're the ones processing payroll, so they have access to that data. So that data was released this week, and that showed 143,000 jobs added, which is higher than 128,000 that were expected, and it was 103 last month. They also revised the number. So last month's number went up a little bit from what the initial estimate was, which is common. These things happen. But if we pair all these things together, this is kind of painting a picture that maybe the job market's not in as tough shape as was seen in August when we got those numbers in. And the reason why this is so important for us with mortgage rates is the fact that the Federal Reserve has made it very clear that they are very sensitive to any fluctuations in the job market, unemployment, things like that. So these are the data points that are very important to pay attention to because it's very likely going to pave the way for whether or not the Fed will continue cutting rates, or rather, if they'll continue cutting rates at a rapid pace. Like we mentioned last time, they came out the gate strong. They came out with a 0.5% cut. The market's expecting more. another 0.75% cut. The Fed has kind of indicated 0.5% by the end of the year after all of what we call the Fed heads, the people who are on the federal members of the Federal Reserve Board, have made comments over the past couple of weeks. The expectations there that, we're going to see further cuts, but if labor shows a little bit more strength, we could possibly not see those cuts. And what that will mean for us with mortgage rates is they go up. Again, this is bringing back what we've been talking about, where if there's not a harmony between where the market is expecting things to go and where the Fed is actually taking things with their policy, we get volatility, we get interest rates that go up. The other thing to be aware of, particularly this week, so when you're listening to this data will possibly be available. Today and tomorrow, there's some other pieces of information that are going to be published that are very likely going to influence mortgage interest rates. First and foremost is initial jobless claims. This is people who are now out of work putting in their claim for unemployment. We also will get the non-farm payroll. This is, I think we talked about it on a prior episode, but it's the payroll, not just ADP. This is across the country, nationwide. People who aren't working in agriculture, farming, if you're getting paid, this is where we get that data. So we're going to see how many jobs are there. We also will get the U.S. unemployment rate on Friday. That is going to be the most important thing, and we could see some more volatility in interest rates pending what that shows us. And then we'll also get hourly wages. This tells us how much money is the average American making, and higher wage growth means more money is going into the economy, and that's good. If there's less wage growth, there's less money going into the economy, more of a cause for the Fed to cut interest rates. The other thing that I'll mention is that with what's going on in the Middle East right now with Iran and the attack on Israel and Israel's retaliation, I was on a call with a client actually just this past week, and we were talking about mortgage rates and we were talking about their interest rate lock and whatnot. And it actually came up in the conversation. And I know it sounds crazy because we're talking about purchasing a property here in the Northeast and we're talking about your mortgage rate, but the conversation was talking about this geopolitical event and ongoing situation in the Middle East, and geopolitical risks do influence mortgage rates. I know it's kind of like a butterfly effect type thing, but all these things do affect it, primarily because the geopolitical events that are happening can normally introduce volatility into the stock market. And when there's volatility in the stock market, the playbook conventionally is that money then goes from the stock market into what's called safe haven assets, which are bonds. Bonds directly have an impact on mortgage rates. Well, not directly, but they are a very important component. So if you have a geopolitical tension rising or an actual war that's going on, and then money starts moving over to the bond market, that's when you have more buyers there. More buyers mean they'll pay a higher price. A higher price means that the yield will be lower. And with a lower yield, we see lower interest rates primarily. So that's the state of things as far as rates are concerned. I will be actually sending out a special episode next week to cover the National Association of Realtors existing home sales data for August. We won't have September until September 24th or October 24th, rather. So for now, I just want to report out what those numbers were looking like by way of the real estate market. But for right now, I just wanted to make sure we covered our mortgage rates and kind of a little bit more of the why behind it. And then for you, if you're a prospective home buyer, stay the course. We're still in a lower rate environment. We're still on the, bottom 10%, I would say, of where interest rates have been over the past year. So this is still a tremendous opportunity to buy. Now, for the Did You Know segment of the show, I'm very excited about this. And today was an easy one because there was an announcement last week about the updates to conforming loan limits. What is a conforming loan limit? Fannie Mae, Freddie Mac, they are government-sponsored entities, enterprises that set forth lending guidelines. And part of those guidelines are, this is the maximum loan that we'll permit. And if it's above this loan amount, we won't be able to provide the financing for that loan. And there are areas of the country, quite a few, that are considered high-cost areas. those high cost areas will have the ability to be above these conforming loan limits. And we don't have exactly what those numbers are, but I won't let you wait anymore. Let's talk about where these new conforming loan limits are. And they're broken out by the 48 states, and then Hawaii and Alaska are separate. So we are going to have, and this is effective immediately right now, we have updated loan limits for the lower 48 states going up to $792,000. Previously, it was $766,550. Then when we look at Alaska and we look at Hawaii, that's $1.185 million is the conforming loan limit, and it was previously 1.149 and some change million. So the reason why this happens is, as we've been talking about, real estate value appreciation has been rapid. So if the price of the home is a little more expensive or has continued to become more expensive, Fannie Mae, Freddie Mac, and these conforming loan limits are adjusted to accommodate accessibility of financing as home prices are continuing to rise. So this has been a couple years now, quite a few years now, of increases to this conforming loan limit. When we get the high balance limits, that's going to be above and beyond this $792,000 number. For example, you would be able to get here in New Jersey a high balance conventional mortgage because this is a high cost market area, and you wouldn't have any issue obtaining the financing. If you go above the high balance figure, then you're looking at what's called jumbo financing. That's one of those rates that we always report out on every week. So jumbo financing is for the loans that are above and beyond the conforming loan limit, and then when you're in a high cost area, above the high balance conforming loan limit. That's our loan limits in a nutshell. That's our Did You Know segment today. Now, what I'm going to share with you is something separate. For those that know me personally, I am someone who is heavily interested and fascinated and daily user of AI. I'm very interested in where this is all going and how it could be beneficial right now. I am a public speaker as well. I have some presentations that I've done in the past and continue to do about artificial intelligence, its history and entry into artificial intelligence, and also discussing some practical ways that you can use AI in your daily routines, personally, from a business perspective, things like that. If you may notice, for those watching on YouTube, I'm wearing something right now. This is the Compass AI wearable. This is not a paid promotion. I am just sharing because I thought it was interesting, and I'm on day one of using it, and I think it's pretty fascinating. So this is a wearable that essentially has a little mic on it, and it sits right here, and it isn't recording what I'm saying, but it's transcribing it into text. And what it's able to do for me, I started using it yesterday in the afternoon to start testing it out. And I had a couple calls. I was on the phone with clients and whatnot. And it's picking up what my end of the conversation is. So from a safety and security perspective, I don't have any concerns. And I am able to have notes after my phone call of anything that I may have shared as actionable steps. It creates to-do lists for me. It's pretty cool. I'll probably give you an update next week, just very briefly on the weekly episode about kind of how it's going. But for right now, it's pretty cool. And I am someone who's very interested in efficiency and wanting to make sure that I'm getting the most out of my day and that I'm staying on top of everything that I need to stay on top of. I wear quite a few hats. So I'm, a branch manager for Guaranteed Rate, and I am also a musician, and I'm also a board member on the local high school. So there's a lot that I do and I'm involved with that I need to stay on top of. So this is a way that I'm trying to leverage this technology in a way that can help me. And if I find use cases that are helpful, I am more than happy and willing to share that with you so that you would be able to possibly benefit from it too. That's it for the show today. I hope you found it helpful and useful. Please share, like, subscribe. If you have any questions, you can email me at peter.d'angelo@rate.com, or you can feel free to call or text me if you've got any questions, anything you'd like to hear talked about on the show, or if there's something that
you want me to dive more deeply into, I would love your feedback. You can call or text me at 973-800-2538. And I look forward to presenting you with a real estate update for existing home sales in August next week. So keep an eye out for that episode that will be forthcoming. But in the meantime, have yourselves a wonderful weekend and take good care.